Hey everybody, and welcome back to the third video on derivatives trading. Today we're going to be talking all about options and options contracts. We're going to be going over what they are and what they're used for because they are talked about quite a bit. An options contract is just a derivative contract in which the buyer has the right to buy or sell the underlying asset at a set price during a set period of time. And there's quite a bit of terminology that goes into options contracts that are important for us to know. So we're going to go through them piece by piece. The first and possibly most important is the strike price. And the strike price is the price at which the buyer of an option has the right to buy or sell the underlying asset. So this is going to be the price that everything is based off of for profits or losses, kind of like the spot price in a futures contract. Now, when we look at options, you can either have a call option or a put option. A call option gives the buyer the right to buy the underlying asset at a set strike price during a set period of time. A put option, on the other hand, gives the buyer the right to sell the underlying asset at a set strike price during a set period of time. Now, this is going to get a little bit complicated, so we're going to look more in depth at what I mean by this later on. But you can also be long or short a call or put contract. So that means that in net you could have four different positions on an options contract. You could have a long call, a long put, a short call, or a short put. And like I said, we'll get into more in depth about semantics and why you would want to take each in a bit. But there's also going to be an expiration date on the options contract, and that's just when the contract expires. And there's an option premium, which is the price of that you pay for an option because options contracts are not free in the market. So let's take an easy example. Let's say that Tesla is right now trading at $395, and you want to take a Tesla long call that expires at the end of June at $400 strike price. Well, since Tesla has been performing quite well lately, and you only need it to go up $5 in the next month, there's probably going to be a pretty hefty premium on the contract or price that you're going to pay the person that you're going into the option contract with that's going to be short the call option. And that's just going to be a little bit of insurance on the person to incentivize them to take the contract. So the more likely that you're going to end up with a profit, the higher the premium is going to be on the option position. Now, we can look at the payoff in a couple different ways. The payoff from going long a call option is pictured on the left. So this shows Apple at a strike price of $310, which means that between 0 and $310, the option is going to expire what we call worthless. And that just means that uh, it didn't make it up to $310, and so it's not desirable for you to buy the contract or to exercise the clause in the contract that gives you the right to get that Apple stock because you're going to make even more of a loss. Let's say that it expires at $290. $290 is what Apple is trading at on the last day of the contract. Well, and you could take the $10 loss that you had to pay for the option premium to get into the contract in the first place, and then after that, it's just a sunk cost. However, if you were to buy the Apple contract, you would be out an additional $20 because you're going to buy it for $310 instead of $290. And why would you want to do that when you could just go onto the market and buy Apple stock for $290? So you would be out another $20. So you just don't exercise the contract. However, after $310, every single dollar that the Apple stock goes up, you get a dollar of profit. And so since you had a $10 premium on the contract, once Apple gets to $320, we call this the break even point. After that, every single dollar that Apple goes up, it is a net dollar profit for you in your pocket. Now, on the flip side, it looks the exact opposite for whoever's short your call option. They're going to have a $10 profit all the way to $310, and then they're going to start to lose money every single dollar that Apple goes up. So if Apple ends at $290, the person that was short your call option is going to make $10 profit on the contract. If Apple goes up to $310, they're still going to make $10 profit. If it goes to $320, both of you are going to make nothing. If it gets to $330, they're going to lose $10 while you make $10. So that's how being long and short works. Now let's look at a put option, because remember, the put option is the obligation or the right to sell a stock to somebody else at the strike price. So you have to pay the premium once again to buy the right to sell the contract, which I understand it sounds weird, but you're buying the right to sell something in the future. And so let's say, once again, $10 premium on the price. Uh, for every dollar above $290, oh, also the strike price is $290. For every dollar above $290 that Apple shares traded at, you're going to make nothing from it, because the idea is that you want to sell it for as high relative to the market price as possible. You know, if Apple's trading at $310, you would not exercise the right to sell it for $290, because you could just short a $310 Apple stock and save those $20. So you would let it expire without exercising the option. Once it gets to $290, you would have it at the market price, so you're indifferent on whether or not you want to exercise your right to sell the stock. If let's say Apple is at $280 now, you would want to exercise the contract, because you're going to sell it for $290, whereas the market price is $280. So somebody would be paying you $10 more than they should for that Apple stock. But again, because the option premium was $10, you would make nothing. However, every single dollar after that Apple stock goes down, you're going to make $1 profit. On the flip side, somebody is going to be short your put option. And so up to $290, they're going to make $10. After that, they're going to lose $1 for every dollar that you gain. So that's how we have the 4 different combinations of being long and short, both calls and puts. So pretty interesting. I understand it's quite a lot, but I promise you, it gets easier with a little bit of practice and talking about them in conversation. So now let's look at how that premium is set. The premium is going to have 2 parts, the intrinsic value and the time value. And I mentioned both indirectly when I gave our Tesla example. The intrinsic value is the value of the contract were it exercised immediately. So once again, the intrinsic value is where the stock is being traded at right now, and if it's a good performing stock or a bad performing stock. It's looking, it's kind of, think about it kind of in the idea of how you would analyze whether or not to buy or sell a stock. Then there's the time value. The longer that an option has until its expiration date, then there's more time for the option to get what we call in the money, which says that it's expiring on the sloped part of the payoff graph. If it expires in the money, then whoever's short the contract is going to be losing it. And the person that's losing it, the longer the time horizon, the more, the higher premium that they're going to force you to pay in order to go into that contract, because there's a higher chance that it expires on that sloped line when you hold the intrinsic value equal. On the flip side, an options contract is out of the money if the price changes are not associated with changes in payoff. So if you think back to the graph we had in the last slide, It If we look at the call option, it's out of the money from $0 to $310, and it's in the money from $310 up. On the flip side, on the put option, it's out of the money from $290 up, and then from 0 to $290, it is in the money. Now, this is a lot to take in, and you have to be asking yourselves, I'm sure, well, why? Why would somebody want to do all this? Especially because why would you short it when you are limiting your payoffs? You can only make maximum of the premium when you're shorting. So why on earth would you do that? Well, the idea is because you never usually enter into an options contract alone. It's what we call naked. When an options contract is naked, it has just your options contract in one position and one position only. And that almost never happens. And if you hear somebody saying that he's just buying long calls or he's just buying long puts, uh, that should immediately raise a red flag because that almost never happens. And so if they're doing that, you should just be thinking to yourself, well, why aren't you just buying the stock or shorting the stock? The reason why options contracts exist is so that you can make these creative hedge strategies. And so what you see in front of you is one example. This is called a straddle strategy, where you buy a call, go long a call, and you go long a put. And when you put them together, what that means is that if the stock increases in price, the call will finish in the money. And if the stock decreases in value, the put will finish in the money. And so all that you need for the stock to do to make money either direction is for it to finish at a higher level or a lower level than what your premium is. So let's use the two examples that we were using before with the Apple stock, where we'll say that this is $300. And then you get a long call and a long put, both with a premium of $10. That means that your maximum loss is $20. And that's if when the options contracts expire, Apple expires exactly at $300. And so you would lose $20 on the contract. However, you need to make $20 somehow, and you would do that by Apple moving position. If Apple increases to 310, the call contract is at its break-even point, but you're still down $10. If it moves down to $290, then the put contract is uh, at the break-even point. But on the other hand, for both options or for both other contracts, they would expire out the money. However, if you get to $320, you're at your break-even point for the entire straddle contract. Or if it gets to $290, or sorry, $280, then you're at a break-even point on the downside. And for every dollar that Apple moves in either direction, you're going to increase your return by $1. So, what would you want then with this strategy? You would want Apple stock to be extremely volatile. And that's where options contracts really dominate is these traders are trying to trade based on a volatility, not one directional change. They don't necessarily think that Apple is going to go up or down. They think that Apple is going to have huge swings in its value. And on the flip side, you can be short this entire contract in what's called a strangle. And so a strangle's payoff, sorry, this is getting a little bit cluttered, but is going to look something like this, where if you think not, Apple's at its market cap is the same as its book value. They don't have any earnings calls coming up. The market's stabilizing finally. It's not going to move a lot. Then you may want to take the opposite side of this position in the graph and say, nah, it's not going to move a lot. So you would make your most money if Apple didn't move at all. And so these traders are trying to trade based on their perceived volatility in a stock. And there's a lot more behind the scenes with options trading and how traders perceive risk, but those aren't really pertinent for the content of the course. And so I'm instead going to leave all that for a supplemental video. So if you're interested in going more in depth on options contracts, how premiums are constructed and what traders are looking for, go ahead and check that video out. If not, I know this was one of the most content heavy videos of the class. If you're confused, please email me or talk to me. Otherwise, you can go on and talk about some swaps.